All right, let's talk about Flexsteel Industries. They just delivered an absolute monster of an earning speed, and the stock, well, it went nuts. So in this explainer, we're going to break it all down. We'll look at the anatomy of that success, how they pulled it off, what the big risks are, and honestly, what this might mean for the company's future.
So, right out of the gate, this is the number that turned heads. A pop of over 20% pre-market. I mean, a move that explosive, it just makes you stop and ask one simple question.
Right? How on earth did a furniture company, in this market, with consumer demand being kind of soft and all these tariff threats looming, how did they deliver such a massive beat? To figure that out, we've got to start with the numbers that kicked off all this excitement in the first place.
Okay, Section 1. Flexsteel's consecutive earnings beat. Let's dive right into the impressive numbers.
So look, the first thing you need to know is that this was not a one-time fluke. This is a pattern. If you look back at Q2, they just blew past what analysts were expecting on both revenue and their adjusted EPS. That's their earnings per share after you strip out any weird one-off items. Then you fast forward to Q4 and boom, they beat their own guidance. They delivered an operating income of 9%, which was way above what they even told the market to expect. You see what I mean? This is about consistent, solid execution.
And you don't even have to take my word for it. The CEO, Derek Schmidt, he summed up the whole year perfectly. He said, "We delivered 7% sales growth in a challenging industry environment." Think about that. Growth in a tough market. They also expanded their operating margins by 270 basis points. I mean, that's a huge 2.7% jump in profitability. And this is the kicker. They generated $45 million in free cash flow. We're going to talk more about that term later, but just know, that's the real cold hard cash the company has left over after paying all its bills. The big picture here is just so powerful. They are growing sales, they're getting more profitable, and they are generating a ton of cash, all at the same time.
All right, Section 2, Strategy, how they did it. So we've seen the results, and they're impressive, but how did they do it? This wasn't just luck, folks. This was the payoff from a multi-year transformation.
When you really dig into it, their whole strategy boils down to these three core drivers. First up, new product innovation. They've got these standout products, like their recliner sleep chair, that are actually pushing them into totally new categories. Second, they have a laser focus on strategic customers. This means they're expanding their reach with huge national accounts. We're talking Wayfair, Costco, and now they've added Macy's to the list. And third, and this is so key, is a relentless push for operational efficiency. That is the engine that's been driving that awesome margin expansion we just saw.
And this slide, this just perfectly illustrates what that efficiency looks like in the real world. I mean, check this out. They became completely debt-free in Q2. They've grown their cash pile to a cool $40 million. And that incredible $45 million in free cash flow, it's allowed them to raise their dividend not once but twice in the last year. This, my friends, is what we call a financial fortress.
Okay, on to Section 3, headwinds. Now, of course, no investment story is all sunshine and rainbows. There are always risks. So, it is absolutely critical that we look at the headwinds Flexsteel is sailing into, and more importantly, how management plans to deal with them.
Okay, the big one. The major risk on everyone's radar is the potential for a 20% tariff on imports from Vietnam. For a furniture company that sources a lot of its products from Asia, this is a huge deal. It could smack both consumer demand and, of course, their own profit margins.
But here's the thing. Management isn't just sitting around waiting for this to happen. They have a really clear, proactive, three-part plan. First, they're making supply chain adjustments, basically diversifying away from Vietnam so they're not so dependent on it. Second, they're digging in to find new internal cost savings. And third, they're doing very limited and strategic price increases. We're talking surcharges between 4 and 8.5%. And get this, they've already checked, and that's on the low end compared to their competitors. Super smart.
We mentioned that term free cash flow a couple of times, and it's so important to this story that we wanted to give you the textbook definition. It's the cash a company generates after it pays for everything it needs to operate and maintain itself. But here's why it matters. That $45 million isn't just a number on a spreadsheet. It's fuel. It's the cash that gives them incredible flexibility and a huge competitive advantage, all without having to take on a single dollar of debt.
All right, so where do we go from here? Let's shift gears and look at Section 4, Management's Guidance. This is what the company itself is telling us to expect for the next quarter.
So, looking ahead to Q1 of fiscal 26, management is still guiding for growth. They're projecting sales to grow anywhere from 1 to 6%. They expect gross margins, that's basically the profit they make on each thing they sell, to be really strong, between 21.5% and 22.5%. And operating income looks healthy too. What's the key takeaway here?
Even with all those headwinds we just talked about, they are still projecting confidence. But, and I think this is a sign of a really sharp management team, they're also realists. The CEO, Derek Schmidt, was super direct on the earnings call. He described the current consumer demand as choppy, and he flat out said that retail traffic has been soft this summer. What does that tell us? It tells us they have their eyes wide open. They're not just blindly optimistic. They see the challenges out there in the broader economy.
Okay, so let's bring it all home. Section 5, our call. We've gone through the impressive numbers, the smart strategy, the very real headwinds, and what management is guiding for. Now it's time to put it all together and give you our analyst perspective.
You can really frame this as a classic bull versus bear debate. The bull case is crystal clear. You have a management team that has proven it can execute, a balance sheet that's as strong as a fortress, and a real shot at grabbing more market share through innovation. The bear case? Well, it's pretty much all about the big picture stuff, macro factors. Will tariffs squeeze their margins? Will a consumer slowdown finally hit their sales? So it really boils down to this: a strong company's execution versus a tough economic environment.
So where do we land? After weighing all the evidence, the execution, the strategy, the risks, our equity research style rating is outperform.
And here's exactly why we rate them outperform. It really comes down to one word: control. In a market that feels pretty chaotic right now, this team has proven it can control what it can control. Their operations are incredibly efficient, their financial health is rock solid, and their strategy for tackling external threats like tariffs, it's proactive, not reactive. And you know what? That is a recipe for winning market share no matter what the overall economy is doing. So the big question we'll leave you with is this: can Flexsteel's incredible strategic execution make it a true standout winner in the furniture space, even if the broader market stays weak? Based on everything we've just seen, the evidence really seems to point to yes.
And just a quick reminder, as always, this analysis is for informational purposes only. It is not financial advice.